Welcome to Adding Dollars. In this video, I'll be going over how much you could have made if you used the wheel strategy on Uber stock. I'll be testing this over a 1-year period and showing you the backtest results. Before I jump into it, if you're new to the wheel strategy or covered calls and cash secured puts, then make sure to pause the video and check out the videos in the description. Now let's go ahead and jump into it. I'll quickly start by describing the wheel strategy, and then we can look at the specific wheel strategy that I'll be running in my backtest. So the way the wheel strategy starts is you start by selling a cash secured put, and then if you get assigned on that position, which basically means the stock ends up closing below the strike price of your put at expiration, you end up having to buy 100 shares of the stock for each option contract that you're selling. So in this example, let's pretend we're selling one put option contract. If we got assigned, we would be obligated to buy 100 shares of the stock at the strike price of the put. So if we get assigned, we now own 100 shares of the stock, and then we would start selling covered calls. So we would sell a call option at a price higher than the shares that we own. And what could happen in this scenario is if the stock price ends up closing higher than the call option that we're selling at expiration, then you end up getting assigned and have to sell your 100 shares of the stock. And then as you can see here, the process would just loop back and start over again. The alternative path is when you sell this cash secured put, the stock price might not come down below the strike price of the put option that you're selling, in which case you're not assigned, which means your cash secured put expires. You just get to keep the premium from selling the put option and then repeat the process. Let's say you do that a couple times, you then end up getting assigned because the stock price does come down low enough. You end up buying 100 shares of the stock, and now you can start doing the call portion of it. If you sell a call, but you don't get assigned, which means the stock doesn't end up closing above the call option strike price at expiration, then your call option just expires, you get to keep the premium, and you just repeat selling calls until this other path happens. Eventually, if you do get assigned and have to sell your 100 shares, again, you start the process over again, and that's why they call it the wheel strategy. Now let's go ahead and look at the specific wheel strategy we'll be doing for these backtests. This is exactly the same diagram as the wheel strategy with just a couple more specifics around the strategy. So in this case, we'll be selling a cash secured put that has a delta of less than or equal to 0.2. You can think of delta as the probability that that option ends up in the money. So in this case, we're only going to be selling options that have a less than 20% chance of ending up in the money, or you can think of that as less than a 20% chance of getting assigned. So you may end up just selling put options for a while because there's only a 20% chance you end up getting assigned. And then once we do get assigned, we'll sell calls that have a 20% chance of getting assigned. So again, you may end up just selling calls, collecting premium until eventually the stock does rise and you get assigned, have to sell your shares, and then repeat the process. Additionally, I'll only be selling options with weekly expirations, so expiring the following Friday. And then I'll also be doing these backtests with only one option at a time. I'm not going to be selling multiple options. If you're interested in seeing backtests with different delta values, different expirations, or a different number of contracts, feel free to leave those down in the comments and I can share the results. Now that we know the strategy we're backtesting, here are the results. I've written some code using the QuantConnect platform to backtest the strategy, and this screen shows the results. This backtest is from December 17th, 2022 to December 17th, 2023, plus or minus a couple days here, depending on when the market was actually open. The main numbers to focus on here are the equity, which is the total amount of money, assuming we closed all positions out at the end of the testing period, and then the percentage return, which you can see right here. The equity that we started with at the beginning of this test was $7,000, and we are ending with $7,468, so a profit of approximately $468, which equals a return of about 6.69% in about a 1-year period. One other number that I usually like to look at with these backtests is the max drawdown, so the maximum amount that the equity was drawn down, or in some sense, a loss on the equity, the maximum amount. In this case, it looks to be about 6.6%. And as always, I like to compare the wheel strategy against a buy and hold strategy. So in the wheel strategy, we have a 6.69% over the last one year. But if we look at Uber, over the last 1 year, if you would have bought and just held, you would be up 139%, which is significantly more. And then similarly, I like to compare this against the SPY. So if you would have bought and held the SPY, you would have been up 21%, whereas the wheel strategy was only 6.69%. A potential reason for this is that the wheel strategy typically performs best in a sideways market, but based on this chart, we can see that Uber has significantly increased in price. So with the wheel strategy, you potentially end up missing out on a lot of the gains when the market is in an uptrend. If you enjoyed this video, don't forget to like and subscribe. And if you have any questions, feel free to leave those in the comments. Or if you have suggestions on what stock you want to see me analyze next, feel free to leave those down below. And as always, I'll see you all in the next one.